Have you ever felt like your money is just sitting there, not working hard enough for you? In a world where financial stability is more crucial than ever, finding the right investment strategy can be a game changer. Many investors are turning to dividend ETFs as a means to generate passive income and build wealth over time. But with so many options available, how do you choose the right one? Today, we're diving into a head-to-head comparison of two popular dividend ETFs, SCHD and JEPQ. By the end of this video, you'll have a clearer understanding of which ETF aligns best with your financial goals. Before we delve into the specifics, let's understand what these ETFs are. SCHD, or the Schwab U.S. Dividend Equity ETF, focuses on high dividend-yielding U.S. stocks. It's designed for investors seeking income through dividends and potential capital appreciation. On the other hand, JEPQ, the J.P. Morgan Nasdaq Equity Premium Income ETF, aims to provide monthly income by investing in Nasdaq 100 stocks and utilizing an options overlay strategy. This approach can enhance income but may also introduce additional complexities. When it comes to dividend yield, JEPQ stands out with an impressive 10.75% yield, paying $5.65 per share over the past year. In contrast, SCHD offers a more modest yield of 3.58%. While a higher yield can be attractive, it's essential to consider the sustainability and risk associated with these payouts. JEPQ strategy involves selling index options to generate income, which can be effective but may also expose investors to additional risks. SCHD's approach is more traditional, focusing on companies with a history of consistent dividend payments. Looking at performance, SCHD has demonstrated strong returns over the past 4.8 years, with a total return of 93.2% when dividends are reinvested. JEPQ, being a newer ETF, has shown a total return of 70.9% over the same period. While both ETFs have delivered solid performance, SCHD's longer track record may provide more confidence for some investors. It's also worth noting that past performance doesn't guarantee future results, and investors should consider their risk tolerance and investment horizon. Risk is an inherent part of investing, and understanding the volatility of these ETFs is crucial. SCHD has a higher volatility of 8.05%, indicating larger price fluctuations. JEPQ, with a volatility of 7.26%, may offer a slightly smoother ride. However, JEPQ's use of option strategies can introduce unique risks not present in traditional equity ETFs. Investors should assess their comfort level with these risks and consider how they fit into their overall investment strategy. Fees can eat into your investment returns over time. SCHD boasts a low expense ratio of 0.06%, making it a cost-effective choice for long-term investors. JEPQ's expense ratio is higher at 0.35%, reflecting the active management and option strategies employed. While higher fees can be justified by enhanced returns or income, investors should weigh these costs against the benefits provided. Tax implications are an essential factor in investment decisions. Dividends from ETFs can be qualified or non-qualified, affecting the tax rate applied. SCHD primarily generates qualified dividends, which are taxed at lower rates. JEPQ's income, derived from options premiums and dividends, may include a mix of qualified and non-qualified income, potentially leading to higher tax liabilities. Investors should consult with a tax professional to understand the implications based on their individual circumstances. Understanding what you're investing in is vital. SCHD focuses on U.S. companies with strong dividend histories, providing exposure to sectors like consumer goods, healthcare, and industrials. JEPQ targets Nasdaq 100 companies, including tech giants like Apple, Microsoft and Amazon combined with an options overlay strategy. This composition can influence the ETF's performance and risk profile. Investors should consider their sector preferences and diversification needs when choosing between these ETFs. For income-focused investors, the frequency and reliability of dividend payments are crucial. SCHD pays dividends quarterly, offering a predictable income stream. JEPQ provides monthly distributions, which can be appealing for those seeking regular income. However, the consistency of these payments can vary based on market conditions and the success of the ETF strategies. Evaluating the historical reliability of these payments can help investors make informed decisions. Choosing between SCHD and JEPQ depends on individual investment goals and risk tolerance. SCHD may be suitable for conservative investors seeking steady income and long-term growth. JEPQ might appeal to those looking for higher income and are comfortable with the complexities of option strategies. Assessing your financial objectives, time horizon, and risk appetite is essential in making the right choice. If you found this comparison helpful, don't forget to subscribe to our channel for more insights into dividend investing. Share your thoughts in the comments below. Are you Team SCHD or Team JEPQ? Like this video if you learned something new, and share it with friends who are exploring dividend ETFs. Your engagement helps us bring more valuable content to you.